Chapter 2: Analyzing and Recording Transactions. Question 1. This set of questions is designed to help you understand the most fundamental and commonly used types of accounts and accounting recording processes in business. Each question corresponds to practical accounting concepts that are frequently encountered. Please read each question carefully, try to answer it on your own, and then check your understanding by reviewing the suggested answers. Let's look at A. What are assets in accounting? Provide 2 examples. Assets are resources owned by a business that are expected to provide future economic benefits. Common asset accounts include cash, accounts receivable, supplies, land, equipment, plants, etc. Let's look at B. What are liabilities in accounting? Provide 2 examples. Liabilities are obligations a company owes to outside parties, representing debts or future payments. Liability accounts include accounts payable, notes payable, etc. Let's look at C. What is equity in accounting? Provide 2 examples. Equity represents the owner's claims on the assets of a business after all liabilities. Equity accounts include owner's capital, owner's withdrawals, etc. Let's look at D. What is an account in accounting? Explain its role and purpose. An account is a record used to track increases and decreases in a specific asset, liability, equity, revenue, or expense item. It helps organize and summarize financial transactions related to a particular category. Let's look at E. What is a chart of accounts? And what is its purpose and content? A chart of accounts is a list of all the accounts used by a business, showing each account's name and number. It does not include balances or transaction amounts. Its purpose is to organize and classify financial information for easy reference. Let's look at F. What is the difference between a general ledger and a chart of accounts? Explain their content and purpose. A general ledger contains detailed records of all transactions and balances for each account. A chart of accounts is just a list of account names and numbers, without balances. The general ledger is essential for preparing financial statements. Let's look at G. What is a source document in accounting? Give an example and explain its purpose. A source document is written or electronic evidence of a transaction, used as the basis for recording it in the accounting system. Examples include invoices, receipts, and purchase orders. Let's look at H. What is the role of a journal in the accounting process? How does it differ from the general ledger? A journal is the first place where transactions are recorded, in chronological order, showing debits and credits. The general ledger groups transactions by account, summarizing them for analysis and reporting. Now, to summarize, assets are the resources a business owns, liabilities are the obligations it owes, and equity is the owner's residual interest after liabilities are deducted from assets. Together, these three elements form the foundation of a company's financial position and are the core of the accounting equation. Each category is tracked through accounts, which record increases and decreases in specific items. The chart of accounts lists all accounts in use. The accounting process starts with source documents as evidence of transactions, which are recorded chronologically in the journal showing debits and credits. These entries are then posted to the general ledger, where they are organized by account for analysis and used to prepare financial statements. Let's walk through the accounting process using Trump Company as our example. We have 9 transactions, labeled A through I, covering common business activities, investing cash, purchasing supplies and equipment, earning revenue, paying expenses, collecting receivables, and owner withdrawals. Our task follows for steps. 1. Journalize each transaction in order. 2. Post them to the T accounts, or general ledger. 3. Calculate each account's ending balance. 4. Prepare a trial balance as of May 31st to confirm total debits equal total credits. Remember, every journal entry flows directly into the T accounts, so accuracy at each step is essential. Here's our first transaction. Trump invests $200,750 cash into the company. We record this by debiting cash for $200,750, increasing our assets, and crediting Trump capital for the same amount, increasing owner's equity. Notice how the journal entry flows directly into the T accounts. The cash account shows a $200,750 debit, giving us a new balance of $200,750. The capital account shows the same amount on the credit side, with its balance also at $200,750. Every step stays in balance, debits equal credits. Now, let's look at transaction B. The company bought $1,500 of office supplies for cash. In the journal entry, office supplies is debited for $1,500 because it's an asset we purchased, and cash is credited for $1,500 because our cash decreased. When we post these to the T accounts, in office supplies, we add $1,500 on the debit side, bringing its balance to $1,500. In cash, we record $1,500 on the credit side, reducing the balance from $200,750 to $199,250. This shows how purchasing supplies impacts both the specific asset account and the overall cash position. Now let's look at transaction C. The company bought $5,050 worth of office equipment on credit. In the journal entry, we debit office equipment for $5,050 to show the increase in our asset, and we credit accounts payable for $5,050 to reflect the new liability we owe to the supplier. In the T accounts, you can see office equipment increases on the debit side, while accounts payable increases on the credit side. This means we acquired new equipment but have not yet paid for it. Instead, we now have an obligation to settle the amount in the future. In transaction D, the company received $16,600 in cash from providing services to a customer. Let's record the journal entry. We debit cash for $16,600. The corresponding credit goes to fees earned, which is a revenue account, to show that the company has generated income. Moving to the T accounts, in the cash account, we add $16,600 on the debit side, bringing the balance to $215,850. In the fees earned account, we record $16,600 on the credit side, reflecting the revenue earned from this transaction. This entry increases both assets and equity, as revenues ultimately contribute to the owner's capital. In transaction E, the company paid $5,050 in cash to settle its accounts payable for the equipment purchased earlier. We debit accounts payable to reduce the liability, showing it has been cleared. We credit cash to reflect the outflow of money. In the T accounts, the accounts payable balance is now zero after posting the $5,050 debit. The cash account shows the payment as a credit of $5,050, reducing the balance to $210,800. In transaction F, the company billed a customer $2,500 for services provided. Since the payment has not yet been received, we record it as an increase in accounts receivable on the debit side for $2,500. At the same time, we recognize the revenue earned by crediting fees earned for $2,500. This entry increases both our assets, through accounts receivable, and our revenue, which will later contribute to equity. In transaction G, the company paid $1,375 in cash for rent. This transaction increases the rent expense account, which is debited for $1,375, and decreases the cash account, which is credited for the same amount. The updated balance in rent expense is $1,375, and the cash account balance is now $209,425. In transaction H, the company collected $1,555 in cash from the customer billed in transaction F. The cash account is increased with a debit of $1,555, and the accounts receivable account is decreased with a credit for the same amount. The updated cash balance is $210,980, while the accounts receivable balance is reduced to $945. In transaction I, Trump withdrew $15,500 in cash for personal use. This is recorded as a debit to the withdrawals account, increasing it by $15,500, and a credit to the cash account, reducing it by the same amount. After posting, the withdrawals account shows a balance of $15,500, and the cash balance decreases to $195,480. Here's Trump Company's trial balance at the end of May. It shows all assets, liabilities, owner's equity, revenues, and expenses from the transactions we recorded. The total debits equal the total credits, confirming the accounts are balanced. In Chapter 2, we answered 2 key questions. First, how do we record transactions? Each transaction impacts at least 2 accounts, and we use the double entry system to ensure that debits always equal credits. We first record these in the journal, then post them to the ledger's T accounts. Second, how do we check our work? At the end of the period, we prepare a trial balance, listing each account's ending balance. If total debits equal total credits, our ledger is in balance and ready for the next step in the accounting cycle. You've completed Chapter 2, From Transactions to Trial Balance. That's a wrap. See you next time.